Hey, how's it going, everybody? Mike Weber here. Today, I want to talk with you guys a little bit about mortgage rates. Now, people have been asking me for the last couple of years, Mike, do you think mortgage rates are going to go down soon? And I've been telling people for the last couple of years that no, I don't think they are. In fact, I think that they may stay high for much longer than everybody expects. Now, of course, most people that are looking to buy or sell real estate, they're all hoping that mortgage rates are going to go down. And pretty much everybody in the financial world is begging and screaming and crying for mortgage rates to go down. And even the president of the United States is trying to force mortgage rates to go down. But there's several problems in the US economy right now that are likely to cause interest rates to not be able to go back down. And I want to share what those are with you today and why I think it's very likely mortgage rates are going to go up or stay high for a very long time in the United States. So let's get started. Now, first off, in order to talk about why mortgage rates are going to stay high, we need to cover a little topic called inflation. Now, historically, inflation has always been tied to the money supply. And when the money supply grows faster than the economy in general, that is really the precursor or the cause to inflation. Now, recently, the government has got very creative and they've tried to really change the definition in the public's eye to what causes inflation. And they say inflation is caused by rising prices, by individuals in the marketplace that raise prices, and they're really the cause of the inflation that we're seeing. So they're the boogeyman, and everything that we're doing in terms of increasing the money supply, that's not the problem. Don't pay attention to any of that. And obviously, most of us know that's total nonsense. All right, so I'm on the St. Louis Federal Reserve's data site. It's called FRED. Everybody uses it to look at, statistical data for the United States. And right now we're looking at the M2 money supply in the United States. And here you can see, obviously, that we have had a very alarming trend in that the money supply is really since, COVID, when they started doing the helicopter money, everybody was getting all kinds of money. The money supply just shot up and exploded to the upside. And there is no signs of the money supply slowing down anytime soon, as you can see here. Now, the problem with that is that the money supply is growing a lot faster than the economy in general. And that is going to continuously put upward pressure on prices throughout the economy. Next, we have to discuss how inflation ultimately ties into mortgage rates. So mortgage rates are really based off of the 10-year US Treasury rate. And let's take a moment and talk about how the US 10-year Treasury rate ultimately is derived. So the 10-year Treasury rate is generally considered to be what's called the risk-free rate. What that really is composed of is short-term government interest rates. And then because it's for 10 years, you add in premiums for term, for the length that the money is being lent to the government, essentially compensation for the unknown of what could happen over the time that you lend the money, as well as inflation expectations, so the inflation that you do already expect to happen, and then unexpected inflation. Now, those are the components that go into that rate from, time zero, or for a short term, a couple days or a week or whatever, loaning money to the government, all the way up to loaning it for 10 years. Now, historically and importantly, there's no credit premium built into these government rates. And for that reason, they're called risk-free rates. Now, in reality, they're not risk-free. The real risk with loaning money to the US government is that you're going to get paid back in monopoly money over time. And so that's inflation risk. Now, in these rates, there is some compensation built in for inflation. However, I would argue that it's way, way, way too low and inadequate to actually compensate for the risk that you're taking of getting paid back with money that has less and less value over time. In order to demonstrate what I'm talking about, let's take a look at inflation and how inflation is ultimately calculated and built into the 10-year Treasury rate. So now we're looking at inflation consumer prices for the United States on FRED again. And what you'll see here is that as of late, the inflation is 2.94%. This is back the end of 2024 when this was measured. All data is currently pointing to inflation going higher. The Federal Reserve is telling us inflation is going higher. We have tariffs, which are likely to cause prices to go higher. And most importantly, we have a government that is out of control, spending money at an increasing pace, creating more and more debt and more money supply that is ultimately going to lead to a lot more inflation in the future. Now, if inflation as measured by the CPI is at 3%, 3.5%, and all signs are pointing to it going higher, let's see how that's going to affect 10-year treasury rates, which ultimately become the rate that mortgage rates are based on. So when we try to figure out what the market believes inflation is going to be over the next 10 years, the way that we generally do that is we take the difference between the 10-year treasury rate and the 10-year TIPS rate, which is Treasury Inflation Protected Securities rate, because those actually pay you for the CPI. So you get like a base rate, and then you get compensated in principal for whatever the CPI ends up being each year over time. Now that's called the break-even rate, that difference between those two rates. And currently, right now, we see that it's around 2.17%. Now, obviously, this doesn't really make any sense, right? This means that for 10 years, the market believes that the inflation that's expected and unexpected is somehow magically going to be 2.17%, even though if we go back here and we look at the inflation that we've been experiencing over the last several years, we were as high as 8%, and then 5%, and then 4%, and now we're around 3.5%, with all signs pointing to more inflation ahead. So really, that doesn't make a lot of sense. The truth is that in order to be compensated for all this inflation that we're likely going to have, or probably surely going to have, given all of the factors that are going to cause inflation, such as increasing money supply, spiraling US debt, deficit spending as far as the eye can see, fiscal irresponsibility, and all these issues, this means that investors who want to lend money to the US really need to be compensated for the risk that they're going to take over 10 years. Now, the important thing is that it's really that 10-year rate, whatever that is, that influences the mortgage rates that we see out in the marketplace. And so if this 10-year treasury rate, the rate at which investors, lenders are willing to loan money to the US government, rises over time or stays high over time, that means mortgage rates are going to rise over time or stay high over time as well. To make matters worse, we have another factor that's likely to make rates go even higher. And that is something called the dollar index, or the value of the dollar in relation to other currencies around the world. Let's take a look at what I'm talking about. So this is a really ominous sign for what's happening in the American economy right now. If we go back here and we look on FinViz, back to, early 2025, we see that the dollar index was trading at 109.90. So we can just say 110 for the sake of argument. Today, just a couple months later, we are down at 99.18. That means that the US dollar has lost 10% in relation to this basket of currencies over just a couple short months. Now, what this means is that if you are a foreign investor and you're holding US assets, bonds, or anything, stocks or real estate, over the last couple months, you've lost 10% in addition to whatever the return on the asset class has been, because relative to your currency, the dollar has lost 10% of its value. So this is not good. So if you're a foreign investor and you want to invest in the United States, or you want to loan the US government money, which means you're going to buy a bond, an asset, and you know that it's likely that you might lose a lot of value on your investment while it sits in US dollars for the next 10 years, guess what? You're going to want to be compensated for that. That is called currency risk, and that is an additional premium that needs to be added on to the 10-year treasury rate if you're, for instance, going to loan money to people buying houses, or mortgage-backed securities, or whatever assets that you're buying that are related to real estate loans and mortgage rates. The compensation is going to have to be even higher to be able to compensate for that uncertainty and that risk that the US dollar will depreciate even further. So when we combine all these things together, you start to get the picture of why it's really impossible for mortgage rates to go back down. Now, of course, the Federal Reserve, they're only able to control the short end of the yield curve, meaning overnight rates that banks, interbank rates, things that are very short term in nature, and they attempt to bring rates down across the yield curve by lowering short term rates. But the problem is what we've been seeing for the last year and a half, whatever it's been, since they've been on a path to lower rates, is that the middle of the curve, let's say around 10 years, those rates are not responding. In fact, they're going up, they're bouncing, they're volatile, and the market is saying, no, we don't want lower rates. We need to be compensated higher rates if we're going to loan our money to you, the government, in order to compensate us for all these various risks, inflation, currency risk, etc. So if we take a look at 30-year mortgage rates, the chart on Fred, look at what we see. We see that rates kind of peaked out 7.5%. The Fed starts lowering short-term rates, trying to bring mortgage rates down, bring all rates down. But guess what? They go down and then they go back up, and they go down and they go back up. And so what's happening is the market is telling us that they need higher rates, not lower rates. So in my view, rates are going to stay higher for longer, and probably much higher for much longer. And to show you what that looks like, let's go back to the 1980s, where Paul Volcker, the chairman of the Fed, raised interest rates very high to combat the inflation of that era. That's actually very reminiscent of the inflation that we're seeing in the last few years. And you can see here, interest rates got as high as 18% back in 1981, and they stayed high for a very long time. I mean, rates were 1978, 9%, all the way to 1987, still 9%. They kind of came back down from the peak several years earlier. Now, the real scary part is that things are very different now compared to what they were like in the 1980s, in that the US government is in a far more dire financial situation. And so the US government cannot afford to have high interest rates, unfortunately, because there's too much debt. And if the rates are too high, that means that the government literally will not have enough money to service the debts, period. In fact, currently just the interest expense on the national debt is greater than all of the defense budget for the United States. And if rates go up, or as time goes on and more of the maturities have to be rolled over, that means that the average cost or the average interest expense is going to rise and rise. And ultimately the US is going to be bankrupt, or much more likely what they're going to do is just print more money. So it's very likely to happen over time, given this dire situation that the US government finds itself in because of all the reckless spending and fiscal policy and borrowing that has transpired over time, is that ultimately we end up in a doom loop, a cycle where the government has only one option to service these debts, which is to print more money. Printing more money causes the money supply to go up. That's a signal to lenders, to the US government, that they need more compensation, higher interest rates to compensate them for that inflation risk that they're going to face from the rising money supply. And as that happens, it becomes a self-reinforcing loop. People demand higher interest rates. Higher interest rates make the cost of servicing the debt, which is exploding, go up. The government has to print more money in order to service those debts, which requires even higher interest rates as compensation for risk, and it just spirals out of control. This is exactly what's happened with every nation in history that's gone down a financial path like the US government. Of course, I hope something magical will happen and somehow, we'll find a way out. But more likely than not, that's not going to happen. More likely than not, interest rates are going to stay high much longer than we expected, maybe much higher than we expected. So you need to prepare, make decisions accordingly. Hope this information was helpful. Don't forget to like and subscribe. Thank you guys so much for watching. We'll see you on the next one. Take care.